Hello, everybody, and welcome to the December 6th weekly review where we take a look at what happened, what should play out next, and how we should be positioned for it. And this week, I'm going to do something slightly different. A couple slides in, I'm going to focus on what you need to do to be consistently profitable because without that, without that guiding principles or those guiding principles, sometimes you have a tendency, not you in particular, but even I, have a tendency to kind of, slide off and do something that doesn't help us become consistently profitable and actually takes away from that. So I want to review, what in my mind is a big part of accomplishing that because that should always be our goal. Last week, in terms of the markets, it was actually a very interesting week. You had big down days coming on Wednesday, and then Thursday, and then a reversal on Friday. So Wednesday reversed, Tuesday's up. Thursday was reversed on Friday's up. And you end up with a, pretty much sideways market with the exception of the Russell. Now, the Russell had outperformed, so for it to give some back or underperform is not a huge issue unless it continues. And so I'll have to watch that because we do want to see rotation into the small caps and into other sectors. As far as the quick review here, what took place was a huge volatility off the central banks. If you remember, Draghi comes out and says that even though they're going to extend how long the QE is, they didn't up the size of the program. That's what the market was expecting. And we got that deliverance from Draghi that resulted in a huge spike up in the FXE. That situation, shall we say, was not unexpected. Actually, we had talked about the probability of that actually happening. I suspect this is going to be a spike to sell. It may make it back to these swing point lows, but if you look at it on a weekly time frame, the high of the low on April 20th is 106.93. They close it at 106.51. So what is that? It's a full bearish retest regenerate, and that comes within 6 bars. So you would expect it to be full, and given the trend, the overall trend, right, you would expect it to actually try to regenerate lower, and that's what it's trying to do. So it's not over yet. We could see it bounce a little bit higher. We could see it even turn this thing sideways for a while and do more consolidation. But this is a weak market overall, and that says that Euro's going to be weak, dollar's going to be strong overall, and we have to recognize that and trade that as part of our trading plan. The thing that it did is it gave the Fed the green light, though, to go ahead and raise those rates, and the market has been anesthetized so long now from the Fed that a 25% rate hike is not going to hurt anything. It's actually good. It's telling you the economy is strong. And if the players continue to play like they look like they're going to play, these are the things that we should expect from that, right? We should expect a stronger dollar. We should expect commodities to be depressed over a period of time still. We should expect money flows. We haven't talked about this much, but we should expect money flows into U.S. equities, from the overseas markets, because not only do you have equities here trying to go up, but you've got the benefit of a dollar appreciation, which, if your currency is depreciating, you don't want to be invested in things that are depreciating. You want to be invested in things that are appreciating. And so we may see some of that take place. And then in general, we should expect other markets to play second fiddle to the U.S. Now, the U.S. market has and continues to pay a lot of attention to what's going on in Europe. I don't think that's going to change, but Europe can handle a pullback. If we look at the European charts, it can handle it. And, everything's set up here properly to allow the Fed to raise rates. So I'm going to switch context here, and I'm going to move to something else, which is becoming consistently profitable, because One of the things I see and I hear is that this is a hard thing to grasp. How do you make certain that your portfolio continues to perform over time and you don't have any large drawdowns? How can you become consistently profitable? And I've listed the three main things. Is you typically need to be trading with the trend on the general market and on the sectors. And when we say that, we're not talking about short-term trend. We're talking about intermediate-term trend and the long-term trend in particular. And I want you to notice that I said general markets and the sectors. So if we take this and relate this to what is going on in our markets, for example, right now, what is the general trend? Is it up? Is it down? Is it sideways? Well, if we just take the S&P, which is the broadest, the large cap broad market, if we're looking at it on a short-term time frame, the trend certainly has taken on the appearance of a bullish trend. You had this big rise off of what over here was a huge drop. You get a big rise, you get a pullback, you get a test, hasn't broken yet. It attempts to pull back again, and now it's testing again. So you have a swing point high right here, right? And this thing's getting ready to try to break it again, right? Try to get over it. If it gets over it, again, that says that this market wants to move higher. And if you just purely look at a trend, trend is higher. It was higher here. It was higher there. It reaffirmed here after a pullback made it sideways. So the general trend on the short-term time frame is higher. If we look at it on a weekly time frame, right, we had gone bearish here when we broke multiple swing point lows. Now we've turned around and we haven't been able to get over this breakdown bar's top. So that general trend here is not bullish yet, right? It's close, but it's not. And by bullish, I mean, there's small anomalies in any model, in any good model. And this model is a pretty good model. And the anomaly here right now is that you've come back so fast and furious that you never set up like a swing point high that you could break. So in other words, if you made this high and you wallow around down here for a while, then break it, this would have changed trend from bearish to sideways. And then the next one, right? The next one would make it bullish. But in this case, because it came up so fast and furious, most likely, unless it goes another 2 bars here and this becomes a swing point high, most likely a push higher right now is only going to break this swing point high, and then you would have a sideways trend. Now, fortunately, on this particular chart, right, you actually have a swing point high here and one there. So if this does break, it's going to go to bullish instead of sideways. And so the trend will, over time, the trend in this model will always correct itself and get on the right side of what it should be, no matter how direct, how fast moves are. Sometimes that anomaly can last for a while, sometimes it doesn't. In this particular case, it will pick it up, but if you look elsewhere, in some of the other indexes or sectors, you may see an anomaly where it's sideways when it clearly looks bullish. Leaving that aside, what's the trend here? Well, the trend right now is sideways basically, right? Because you've got 2 big ranges. You've got this range up here in this area, and then you have the range up underneath it down here, right? And so we're up in the top half of this, and we're trying to get higher. So at this particular point, for all intents and purposes, the range is pretty much sideways. And we know that because of other things that we're looking at, which are these bearish retest regenerates unable to regenerate lower. That gives us, quote unquote, an early warning system that no longer is it down in this case, but it's sideways, right? That's what it tells us. Why is this important? Well, because you need to know what the general trend of the market is in order to be on the right side of the trend, trading with it. Clearly, on a monthly basis, right, on a long-term basis, this still remains up. It hasn't changed yet, and the reason is because it hasn't broken a swing point low. Now, this doesn't change very often. We're talking, once or twice every 4 or 5 years. They don't change that often. So when it changes, it will be important. Long-term trend, higher. Intermediate term trend, sideways. Short-term trend, higher. So which direction do you want to be pointing? Well, clearly you want to be pointing up most of the time. And so when you know that, right, then that's what you try to do. And then you try to do the same thing with the sector. You find those sectors that are strong, and you tend to concentrate your bets in those sectors. Once you know that, then you want to find the strongest and weakest. If you're, if the general trend is bearish, you'd want to find the weakest. If it's generally bullish, you want to try to find the bullish individual stocks in those strongest sectors. So you first define, what's the trend, right? What is the trend? Once I know that on the general market and on the sectors, then I go find the strongest ones, right? If it's bullish, on the strongest sectors, right? Go find the strongest individual stocks in the strongest sectors. Once I got that, now I've got the gems to work with. And then you try to work with those, and then it becomes a question of how much exposure. How much exposure do you want on, given how strong or how weak these things are? That's the holy grail, folks. Know which way to point, right? You got to know where to point. You got to time your entries pretty good. And then you need to know how much exposure to put on. That's it. That's the holy grail. How do you know this? Well, this one is a little bit harder to know, right? How much exposure, because it's a judgment call. You got to look at a bunch of stuff to decide that. Strength of the trend, how extended it is, what the range projections look like. Are the ABCD projections, right? Are they close to their tops already? Have they already done the run? What's the overall markets doing? Because that, it's a world market anymore. That's going to affect you as well. Any of the risk profiles that might exist. And what I mean by that, of course, is multiple time frames breaking. So, if I look at the current market, and let me go back to that chart. If I look at the S&P 500 and I pull it over here and I look at it, I've got one swing point low down here at 2021. Do I have anything down here? Not yet. If we go sideways long enough, these will print as swing point lows. They're at the same price point. So again, you can see that structure will form actually right about where it should, which is right here. And this type of action happens all the time. You get some sort of spike up, you get a test of that spike, eventually this becomes a swing point low, and then on a weekly basis, on a daily basis, a break of this area becomes problematic. And so you can begin to see what your boundaries look like. Consequently, on the top side, you get the same thing, like here, right? And this potentially can print, and this is all on the weekly. If you pull this back, put it on a daily, you've got, let me grab the daily here. Where did the daily go? Here we go. On a daily, you've got a swing point high printing right there at 21.16. And if I look at the weekly again to get the number there, 21.16, that one's at 21.32, and this one over here is even higher. So the 21.16 happens to be this one. And so you can see if it surges quite a bit, you're going to get a break on multiple swing points. If it doesn't, then you won't. But that, is the risk structure, the reward structure that you're looking for. Always look at risk first, right? Always base your decisions on what your risk is. That is how to be consistently profitable. Okay, so I'll keep trying to work these concepts in future shows, but I wanted to take a little bit of time because I keep seeing and hearing deviations from this, which I don't think are healthy for you to do with respect to your portfolio. Moving on to the regular part of the show here, technical picture. What do we have? Some technical positive takeaway bars on Friday, after the bearish ones on the Wednesday. So if we look at here at, say, the Nasdaq, you can see that structure that took place here. So essentially, a takeaway bar sometimes ends up being a bearish engulfing, which it was in this case. And then we actually did the opposite, a takeaway bar back the other way, which wasn't a bullish engulfing because it really didn't cover the entire candle body, but it ended up back at the highs. So, here we are sitting here, at least on the Nasdaq, essentially at the highs, ready to test and try to break higher again on the daily time frame. If you look at it on the weekly time frame, we actually had, let me grab the weekly, we actually had the breakout here extend, right? It comes back, leaves a long tail. Well, a long tail is a good thing, and because a good situation where bulls outnumber the bears at the end of the week, at the end of the day, that's when you get these long tails, and that just tells me that they're more in control than those trying to sell. There's the multiple swing points we just talked about, and those multiple swing points exist on multiple time frames, just like they do here on the Nasdaq, as we saw on the S&P. And we could see, as a result of the dollar weakness, we could see the emerging markets start to benefit some, and that would be a big positive if they did, because you had some difficulty taking place in these markets, and they kind of need to lift to take off some of the gloom and doom that's taking place around the world. So, if we get a lift in these markets, I think it's a good thing. I think Europe is in a situation where they can allow a lift to take place. If you do the ABCD projections here, they had a nice one already play out once. Now they're going to try to do another one and take it back up to the top of this bearish retest regen zone. So if it happens that way, I think that's a positive overall, because you don't want to see part of the world really get too negative on you, and this one's starting to get too negative. To the point where, if we take and look at the monthly chart, we've already broken multiple swing point lows. You need a bounce in this market. You need it to take it back up and at least get it, at least testing these swing point lows on the monthly. If those markets continue to disintegrate, they eventually will affect our markets as well, and that's why it's important that the whole world not see extreme pressure in any one region. So if I had to list the negative, it would be that, if we didn't get this to happen. But right now, on our markets, the negatives, it just hasn't been able to break higher, and that's about it. If we look at the fundamentals, there's enough mixed data to keep the recession screamers at bay right now. That's true in Europe. It's true here in the U.S. And then you got the central banks coming up. Bank of Japan, the Fed. I think actually the Bank of England is this week, although I don't expect there to be any changes there. I don't think it's going to be a market mover. Fundamentally, on the negative side, you got this tremendous turmoil, both domestically, geopolitically. There's all kinds of things happening everywhere. It just seems like a deluge anymore. The big picture deflation is still out there. All these debt structures are out there, which is what we keep seeing in the emerging markets, which is one of the reasons I think that if the dollar can hold in this range, we may see those markets lift some, which is really something we need if our market's going to continue to lift. I've started adding in this money sectors on the equities, the money flows. And these are all domestic, and so I broke them down into the major sectors so that you can see which ones are moving the most on a weekly basis versus those that aren't. There's places you can go and find this kind of information, but I thought I run these queries in my database every week myself, and so I just thought I'd start throwing them out here and let you have them. I've been trying to find an easy way, that I could give you this kind of information where it's not overburdensome on myself to look at, all the charts, and so this is an easier way. You can see last week, for example, technology continued to be the standout, but we saw some rotation in the financials. I think you're going to continue to see that this week. If that's true, the S&P is going to try to get over that breakdown bar because this is just a large weighting. If we look at on the negative side, XLE, of course, most negative. OPEC doesn't put any kind of ceiling on the production. This will be a key this week. Does it quit bleeding or not? It had signs Friday of doing exactly that. On the minor sectors, what was happening there? Well, it was the dollar. The dollar pulls back, and you get things that hadn't been going up, like the GDX. And then you also saw continued money flowing into other energy sectors, which was interesting. FAN and PBW, which is the windmills. So I think that no, that's clean energy. Actually, that's the broad one, the power shares. So it's just interesting to see what's moving and to be able to look at that. Here's another one that's associated with the financials and the broker dealers as well. If you go to the downside here, the ones, of course, that really got hurt were shipping, frac, the steel industry, the oil drillers, and so forth. So it's not a huge surprise here what's moving on the downside. One thing that continues to be a thorn out there is the IYT, the transportation index. This continues, if you're a Dow theorist, this continues to tell you that this market's in trouble, even though it hasn't given it up. And speaking of the market in trouble, on a big picture, if you want my overall view, we are not at the beginning of a long trend higher. Maybe this trend's going to be able to, grind out for another year or two. I don't know that it will, but maybe it will. And we can't decide what that is a priori. What we have to do is keep looking at what it does on a week-to-week basis and make our decisions, right? By doing that, we will be where we need to be in the long term. We don't have to know what the long term is. We just have to keep positioning on a short and intermediate term time frame in the direction of the trend. And if we do that, we'll be where we need to be at the end. As far as what I expect this next week, last week we thought the dollar might stop ascending. It did, right? With ECB disappointed, which we thought they might. And then will we get over that breakdown bar? It was a wild card as to what the U.S. domestic equities would do. They actually sold off and then bought them back. And so this is still out there. I still think that is a big piece that has to be brought to bear. In other words, if we get over the breakdown bar on the S&P 500, I think that's going to signal new highs. As far as rotation, are we going to see it come back into the IWM, into the Russell? I think if it does, that's going to be a huge positive as well. Economics, not a lot going on. Fed speakers shut up finally because they got the Fed meeting next week. Retail sales, probably the biggest domestic point. You got some industrial numbers overseas. What's the bottom line here for me? Everything that I said last week is still the same, right? Nothing's changed. We can get to new highs by the end of the year, if these things that I've developed continue to develop. What remains true is that it's not easy. As you get farther and farther along in a bull market, right? The idea that bull market is going to continue gets heavier and heavier to hold. And we're 5.5, 6 years into one, and so it's very difficult to keep pushing this thing. So from that perspective, you have to realize that it's not going to be easy. There's going to be a lot of churn, and it continues to be a lot of churn. We're also not seeing the world contributing to growth, in a general way, right? We've got so much debt out there that it's hard to see huge growth. And as a result of that, companies are not able to expand their revenue streams. And so, it's not any wonder that we're having as much difficulty as we are. But so far, the market keeps telling us it wants to go higher, not lower. And as long as it does that, we have to try to stay with it. I wouldn't expect a huge push higher from here. But if it happens, I'm not going to be surprised. And the reason for that is, if you remember back on the charts I just showed, if the S&P starts to break out, it's going to break out potentially on multiple time frames. The same thing on the NASDAQ. The NDX has already broke that top, right? And then the Russell would be bringing up the rear. But if you get those breakouts starting to occur, you can get a big push. And that push could take us close to 2,200 on the S&P. It could take us up to 2170, 2180 easy. So don't be surprised if it happens. Don't expect it, but don't be surprised. And that's why you have to have risk on in this market, and that's why we have it on in the portfolio. And speaking of the portfolio, you can go through all of these and look at them, but essentially, we had some partial gains that we took, and then we added back on some of the weakness that took place this week as well. We're still heavily invested, and we're going to stay that way as best we can. We're going to stay that way until the end of the year. All right, I'm a little bit long. I'm trying to keep this 15-20 minutes. I'm long today because I wanted to add that one piece, but I'll try to get it. I'll try to keep it 15-20 minutes. Thanks, folks. Take care. Bye.